I'm Corbett Wall with DV Auction, here with your feeder flash for Thursday, August the 1st. And the system is broken, and I'm talking about how we trade these fat cattle. And you guys know that I talk all the time about not nearly enough negotiated trade and things like that, and way too much of the volume is traded on formulas and things and it's basically based on about 15%, the other 85 trade on about 15% of sales, which is a tail wagging the dog, and that doesn't work. But I'm going to go into something a little bit different that's broken this time, and I stole that system is broken from a friend of mine in the industry that I was talking to. But you know, we come out of the box here earlier this week, and on Tuesday we saw some sales that were higher. We saw the dress sales up in the Northern Plains that were mostly 185, and the previous week, last week, they were mostly 183, 184, and actually your weighted average was in that 183 range. But it was looking like we were going to be quite a bit higher on that range, on that price range on your dress market. We didn't see any significant live sales up in the Northern Plains, but it was evident how hungry your packers were. They were short bought. They hadn't been buying any cattle for the 2 to 4 week delivery for the last several weeks, so they don't have any of those cattle coming. They're just there with their captive supplies, but they've got to fill in around that, and which made it a perfect storm to gain another dollar on your negotiated trade, and it looked like that way. The problem was that your board has not been keeping up. We cannot get any support from the board. And even though your hedged feeders like to see a big basis, a big difference between your cash price and the board, if your cash live price is higher, then they like to see that. That's a bonus for them. So you see how that works. The way this system is supposed to work, if you use that Chicago Mercantile Exchange futures market as a risk management tool, and it's a good tool, been around for a long time, and so your guys that are feeding cattle, and I'm trying to dumb this down. Most of you guys say I'm pretty good at dumbing things down. That's because I'm dumb. But it's kind of like being a rodeo announcer. You're trying to engage with the people that are at their first rodeo without boring the other people to death. So that's kind of what we're doing here, but I'm struggling with it a little bit. But the way that's supposed to work is your guys that are feeding cattle, they sell or take a short position on your futures market. A lot of times they'll use options and things, or different risk management strategies. But at the base, they're wanting to sell that futures because they know that they are long in the cash market. So they need to offset that being short in the futures market. So whenever the market goes down, sure, their cattle are not going to be worth as much, but their position on the futures market is going to gain steam for them. And the way that was supposed to work is your packers were going to be on the other side, because they knew that they were going to have to buy cattle. They know they're going to have to buy cattle all along. So you would think that they would go out there and go long the futures market to offset where they needed to be. And if the market went up, yeah, they were going to have to pay more for cattle, but they were going to gain it back on the futures market. The problem is your packers are so big, your big four is so big, they don't need a futures market. So they can just use contracting, they can use out front formula sales, they can get captive supplies. They've got about 85% of their needs already filled, so what do they need the futures market for? And for them to take the position that they need to be going long, that supports the market, and it's in tail going to support your cash market too. Well, that's the last thing they want to do. They don't want the market to go up as a whole, because then it's going to cost them more on all those contracts and formulas and everything that they've got out there, and it just doesn't work that way. So you only have people you have to go long on the long side is your funds, your speculators basically. And they don't always want to be long. It's so much easier for them to be short too, because the industry is putting so much pressure on itself, taking short positions to manage the risk of being long in the cash market. So You just always have to depend on these speculators, these fund managers. They love the cattle futures because it's a shallow pool, and then they can kind of manipulate it and they can kind of make it do what they want to do. But what we've got now is we've got a lack of longs. Nobody wants to be long. There was a time not too many years ago, and he finally got penalized enough that they've kind of backed out of it. But there was a major risk manager for the industry that would take long positions. Yeah, they were short a pile of contracts doing risk management for their customers, but they would take some long positions, hold on to them, and actually take delivery of the fat cattle just to keep that market honest. But we don't have anybody to do that anymore. In fact, your only longs that are out there, your funds, your people speculating in the market, they don't want to stay hooked until the contract matures, because they don't want to take delivery of the fat cattle. They don't want the real product. They wouldn't know what to do with it. And you still have the threat of actual physical delivery in your live cattle arena. And for all this time, that's what's kept the bite in it and what's kept it true and kept the open interest up and the volume going and everything else. That's some of the problem with your feeder cattle contract. You just have cash settlement, and on your lean hogs also have cash settlement, so they don't seem to have the bite. But now we don't have any industry people on either side being long, and they when it gets close, like this August is getting close now, they get scared. And you don't have to go that many business days within the contract month before you can get a threat of delivery. And even though your futures market is running, so many dollars back, $4 back or whatever of the cash market, they still they get nervous right in there, and they start dumping. So nobody will stay hooked. So that's where we're at there. So you have nobody that'll stay in that contract. Then you've got all these hedged feeders. The few guys that are still selling cattle, negotiated cash, are the hardest headed ones left. And they're also the most independent when it comes to trading. So they won't get together with the other guys that are trying to sell negotiated. They want to be mavericks. They want to do their own thing. And okay, you do that. You go ahead and hold on to them. You dig your heels in and ask for more money. Meanwhile, I'm going to jump over here because I can get a basis over here. It's going to help me make my break even and even pick up a few dollars. Because whenever these guys hedge those cattle, they're basically selling them for whatever price that board is way out front. And if they can live with that, with the way they're feeding their cattle, with their cost of gain, then they're fine. But whenever it gets close, like it is now, and we've got this market that's around $1.11 cash, and your board closed today under 107, well, the difference between that is the basis, and that's basically a bonus that they get to keep. Well, anymore, that's what everybody's banking on. Whenever they're doing their break-evens, whenever they're setting up their risk management, they're counting on a $3 to $5 to $7 basis, and they're actually plugging that in on their break-evens to make it. And they shouldn't be plugging that in. That should be just a little bonus there at the end if it works out that way. But it's much like your row crop farmers putting their cheese check from the government in on their break-evens, but they have to do that nowadays. They couldn't operate without the government helping them out on most of your row crops, and whether it be your government subsidized insurance, crop insurance, or what have you, they plug that in. But it's just not working. So then you've got guys out here looking at that board, they're looking at the cash market they can get, and they can't resist that basis. We call them basis jumpers. So on a day or a week like this week, where a week ago we got a 111 in the Southern Plains, and that was a buck higher, and that was everybody was feeling good like this, and then we saw the Packers come out aggressively early this week. Well, naturally, you thought that they were going to get $1.12, $1.13. Well, actually, they only got $1.11. And they didn't even stand up and down and hold their ground for that steady $1.12. They could have got $1.13 easy. They could have asked $1.15, waited till Friday and seen what it was going to do. But they bailed out at $1.11 because it was there. Well, that just cuts the legs out from under everybody else that needed to trade. And you cannot get any market position. These basis jumpers don't deserve any market position because they prevent the rest of the industry from getting any. But we had somebody, actually it was early in the day on Wednesday, that jumped at the basis, probably on some plain cattle, just outside on the southern edge of the Texas Panhandle there. Well, that locked the market in. And everybody, my phone blew up. Everybody's phone blew up. Can you believe that? $1.11. We knew we had $1.12 in the bank. And I think I made a mistake saying that 11 was steady. The $1.12 would have been steady. $1.13 is what we needed to get to gain another buck. Could have asked $1.15. No telling what you would have got. But the board was down on Wednesday. Somebody jumped at $1.11. Guess what? That's where we're at. It's $1.11. By the end of the day, you had some of your marketing cooperatives taking $1.11 for some cattle in Kansas, and probably because the owner said, hey, I want to do that because I want that basis. But it's not working right, and I don't know what kind of deal we're going to have to change to get this to work. A lot of people say there won't be any negotiated trade at all within a few years. How could the packers get it any better? They absolutely love it the way it is right now. They trade on such a small pool of the total volume of cattle, and then they get to buy all the other cattle the next week at that price. It's unbelievable, and everybody keeps blowing their brains out on these feeder cattle and trying to make it work. And I'll say it once again, as long as you're buying feeder cattle in an active, competitive market like you see in these auctions around, like everybody's buying these feeder cattle in, especially these green grass yearlings because they perform so well. But they're buying feeder cattle in an active, competitive market. They're selling fat cattle in a non-competitive market. And it makes for a piss-poor investment and a hard way to make a living, and it's hard on the industry. Even though most of your cow-calf guys don't do that, very few of them retain ownership all the way through. That's the top of the chain, and then it trickles down. So it's inevitable that your cow-calf guys, your stocker guys, your grazers, your backgrounders that use growing yards, everything, they're just going to have to start taking less and less for their cattle. We already in 2018 set an all-time record for producers getting the smallest percentage of the retail beef price. And that's going to continue. You see your beef packers having record profits, just outlandish. They're singing the blues right now because they're just making a little over $200 a head. I guarantee you if these cattle feeders were making consistently $200 a head, they would be dancing a hoedown in the feed alley. And you guys know it's true. But every time this kind of shows its head up again, and we sometimes forget about it, but we see talk of changes. Heard talk of changes this afternoon. Actually, a good friend of mine come up with a good scenario of a way to change the futures contract. Not kick the CME out of it, but make something that's more workable. Talk of changing a contract to a cash settlement because nobody wants to take delivery anymore. And actually nobody really wants to deliver anymore. So if they don't want to do that, let's have a cash settlement that your funds and your speculators have a better feeling about, and they're not as scared to stay hooked when the contract starts to mature. And have one that's set up like some of your other money market things, like your S&Ps and things like that on the futures, that have several settlements during the life of the contract. And so it keeps that thing true all the way through, and it doesn't start wandering off everywhere where you get these huge bases where it doesn't even seem like your futures market has anything to do with what the actual the product is worth whenever you're not close to the contract month. And now you're getting where it doesn't even come together at the end. But something needs to happen with this thing. I know there's a lot of problems in a lot of industries, but the way we sell these fat cattle is getting to be a big problem. And I know the formula guys are sitting back and and with their fingers crossed and their feet up like usual, riding on coattails, thinking, yeah, that's how come we don't do that. Well, you guys survive on what that little bit of negotiated trade is. You get it, you're a week behind all the way through. And if this deal really starts struggling, what are you guys going to do? I know what the big corporates are going to do that's completely in bed with the covers pulled over and tucked in with the packers, but a lot of you independent feeders have got those same agreements too. And if this deal gets to where you can't seem to find any cattle that'll hedge to buy as feeders, what are you going to do then? And what are the guys selling them going to do? And then what's your cow-calf guy going to do? It's really becoming an epidemic. But let's look at that down board for Wednesday. August live cattle futures down $1.20 at 106.90. October down $1.42 at 107.65. August feeder cattle down $1.57, taking pretty much everything they gained at 141.52. September down $1.60, 142.45. Talked about that fat cattle trade. The Southern Plains sold some cattle, and not a significant amount. I still wouldn't doubt that we could get some $1.12, some steady money in there somewhere. But there's been enough cattle sell at $1.11, and your packers really don't need cattle. They need cattle up north, not so much down south. But that's what trucks are for, to haul them up there. But they'd a heck of a lot rather buy them at $1.11 and then put $3 or $4 freight on them to go up north and still have them up there where they need them cheaper than what they buy them up there for. But that's kind of where we're at now. But some cattle sold in Texas and Kansas, not a lot, but it doesn't take very much. You know, besides your marketing cooperatives in the Texas Panhandle, there's very, very, very few guys that actually sell their cattle negotiated cash. In fact, you can fit most all of them in the front seat of a regular cab pickup. But 111, the Southern Plains. Okay, now the Northern Plains, they're really current. They're short of market-ready cattle, all because of that flood waters and everything that they had whenever those cattle would have went in. And Nebraska had about 3,600 head confirmed. It was 185 mostly, but then turned 183, and then that was spotty by late in the day after the Southern Plains guys got done with their flop. And Iowa, 3,200 head in Iowa, they sold some cattle Wednesday morning at 115 and mostly 185, but it started backing up to 183 too. So you see how that deal works? But it's just a pretty pitiful situation. I want to talk about some other things in your feeder cattle market. Don't forget about all the happenings in South Central Kansas. On Thursday here, Pratt's going to have a huge sale, 7,000 head of feeder cattle, and I guarantee you Mark and Brian Winter are not tickled with what the guys did in the Southern Plains on their fat cattle trade this week, right ahead of their sale. I guarantee you they're disgusted about it too. Maybe the board will bounce back for them on Thursday, but got a big sale in Pratt, 7,000 head at Winter Livestock in Pratt. That's getting all ahead to the big happenings this weekend. Friday, got a High Plains video there in Dodge City, Kansas. Winter Livestock putting on about 10,000 head on that High Plains video, all leading up to Saturday, Dodge City, Kansas, Winter Livestock auction. Watch it on Cattle USA. They got the King of the Ring, the best of the best auctioneer contest. You guys might get sick of the auctioneer contest. I really enjoy them. The industry enjoys them. It promotes the industry in a positive light, and they're a lot of fun. But I'm going to go up and watch that. If you guys have a chance to go up, if you see me and you watch this program once in a while, I want you to come over and say hi. Tell me what I'm doing wrong. But another thing that's happening, I told you about those Wisconsin brothers up there in northwest Missouri where I used to live. And the news just keeps getting worse out of there. They haven't got a whole lot of things confirmed, but you know, on that Nick and Justin Demel deal where they went down to check on some cattle, they had a kid feeding for them down there, but they came up missing. Well, now they have confirmed that they have found human remains on the property. and they have not confirmed who it was, but you know, the chances are awful good that it's probably them. They're running DNA tests in the lab and everything. The thing that really makes you want to puke is that they removed the hay grinder from the property and then took it to a crime lab. Tell you what, desperate people do desperate things, but it's hard to imagine. But let's talk about your feeder cattle market. Your real-time index, cattle market central late on Wednesday, 139.03, down $1.04. You can blame most of all that on your Southern Plains basis jumpers too. It was going pretty good early in the day until word got out of that. But OKC West, El Reno, Oklahoma, 8,000 head total, about 6,500 head of yearling feeder cattle on Wednesday. The balance of them on Tuesday's calves, but not well tested there. But feeder steers steady to $3 lower. That's the first time we've had a lower market on a Wednesday for a few weeks there. But feeder steers were steady to $3 lower. Feeder heifers $2 to $4 lower. Look at this report out of Cattle Market Central market report there, and look at your best tested weights on steers. 929 head of 7-weight steers, average 746 at 137.10. It's about $3 lower on your weighted average than last week. 1,327 head of 8-weight steers, averaged 850 right on the button, with a weighted average price of 134.64, and that was about steady to $1 lower is all. And then close to 900 head of 9-weight steers there, average 949 at 123.88. And on the weighted average, compared to the weighted average a week ago, that was about $5 lower. And those are the cattle that are closest to the knife there. But what about your heifers? 1,249 head of 7-weight heifers, average 749 at 129.95. And that was off about $4 there on your weighted average. Look at this individual quote on the biggest string there. 231 head of steers weighed 875 at 134.25. And that's your market, guys. The best quote I saw on 8-weight yearling feeder steers was way out west in Bluegrass Stockyards East, Mount Sterling, Kentucky. 59 head of 812-pound steers in Kentucky bring 144.10. And that's your feeder flash for Thursday.